And if everybody wants to go ahead and, awesome. Why don't we have everybody mute themselves? I will be watching the chat. So if you have a question, put it in there and then we'll open up at the end, okay?
Okay, awesome. Thanks, Bliss, for the intro. And for those of you who haven't joined us before, well, here, I'll get into the outline on what we're doing today. And then, yeah, we'll go from there. All right, so today this is what we are going to talk about. So what has happened since the last time we did the Zoom call back in March? There's been some exciting things happen. What happened at the Fed meeting yesterday? What did they announce after meeting? What forces will continue to impact mortgage interest rates? Quick update on the housing market. And then as Bliss said, she's going to talk about the emotional side, what you can do to help your clients feel more comfortable in a quickly shifting market. All right, so this is actually a quick reminder. So, and I think this is important because no matter how many times people hear it, they seem to get confused. So supply and demand is something we hear all the time, right? And how prices change based on that. You can think of rates, mortgage interest rates, or really any type of rate, interest rate, as the cost of borrowing money. So it's similar to any other commodity or good in our economy. There's a supply and a demand for it. So all these factors that we talk about shift the supply and the demand of borrowing money and in turn affect interest rates. So supply has an inverse relationship. So as the supply of money goes up or the money available to lend, rates go down, and then vice versa. And then the reverse relationship is true with demand. As the demand to borrow money goes up, rates go up as well. And we had a more in-depth conversation about that the very first meeting we had. And that's on Bliss's YouTube channel if you're interested in that. And then again, just to define the federal funds rate, because again, people hear this in the news and they don't understand what it means. The Fed funds rate is not mortgage interest rates or credit card rates or anything like that. It does have a direct impact, but the Federal Reserve is not turning a knob on all interest rates. What they set is the rate that banks can lend money to each other back and forth overnight. That's what the Federal Reserve controls. And again, it does impact everything, but I had a borrower talk to me Monday and said, I heard that the Fed is going to increase mortgage rates, so I want to lock in now. And I said, well, that, it likely isn't going to make much of a difference. And I kind of had a conversation on how the Fed impacts mortgage rates, but doesn't control. So that's an important thing to remember when people are freaking out about rate hikes, that it's not an exact correlation. Okay, so what happened in April? So Fed Chair Powell stressed the need to control inflation. That's what they've been talking about all year, that inflation got out of control. And that's the whole reason that at the beginning of the year, they announced rate hikes all throughout this year. So it's getting a little more dire. And in April, he stated that they may need to raise them more quickly than what they thought at the beginning of the year. So that announcement in April increased mortgage rates, because mortgage rates always act in anticipation of what's going to happen. Okay, that's another key thing to remember. So there was no Fed meeting in April. I think I put that. So there was no Fed meeting. There were no increases in Federal Reserve rates, but just that announcement increased the mortgage rates. All right, COVID in China and Ukraine invasion continue to disrupt world markets, which is bad news for mortgage rates. I know we don't think about COVID a whole lot anymore, at least I don't. It doesn't seem to be in the news as much, but it's still been an issue in China. And with how their government works, they can shut everything down as they need and want. So that's been a problem. And then, like I just mentioned, there was no Fed meeting in April. All right, what happened in May? So there was a Fed meeting and they increased the rate by 0.5%. That was expected. So that actual increase didn't move the needle a whole lot. And so this is actually a good example of what happened in May of interest rates, mortgage rates moving in anticipation. So they increased 0.5%, the Fed rate. That was expected. So rates didn't really move the needle that much because it was built in to the expectation. But then there started to be rumblings about 0.75% the next Fed meeting, and rates started to climb, mortgage rates. And then Fed Chair Powell came out and said, no, that's unlikely that we'll do 0.75%. And so then things kind of calmed back down. And that's, spoiler alert, they did go up yesterday, 0.75%. Inflation actually started to look better in May, but there were still some global market disruptions. And then rates did seem to peak in early May and then ended lower by the end of the month. So that was really encouraging. That's where my optimistic side, and I know Bliss is optimistic as well. We were like, all right, we hit the top. We're in good shape. Because they actually ended the month lower than the peak. All right, and June 15th, yesterday, this is what happened. There we go. It did go up 0.75%, which was the biggest rate hike since 1994, which doesn't seem that long ago, but that's like 28 years ago. Continued hikes to get to 3.4% by the end of the year. We're at about 1.5% now. And again, this is the Fed Reserve rate. Now that is important because at the beginning of the year, the anticipation was 6 rate hikes throughout the year of 0.25%, which would put us at 1.5% for the year. But here we are mid-year already at 1.5% with a target to more than double by the end of the year. And then 0.5% increase is most likely, but we could see another 0.75 at the next Fed meeting. There's been no official announcement on that yet. That's just the feeling that 0.5% is the most likely, but it's really going to depend on how things react to this most recent rate hike. All right, so this is a chart that I've showed before and I didn't update it, so it's going to be out of date, but that's not the point I'm illustrating that I want to show right here. So the blue line is the Fed funds rate. So you can see how it's stepped, and that's because it's decided on 8 times a year, and then how mortgage rates change. So the things I wanted to remind and point out is during this whole period from 2012 to 2016, it remained flat, the Fed funds rate, but you can see mortgage rates are all over the place. So again, that's the federal government does not turn the knob on mortgage rates. There's a lot of things that impact it. The other thing I want to point out are these highlighted sections where when the Fed rate increases or is steady, mortgage rates can drop. There is a lot of historical precedence for that. Again, here, Fed rate is increasing, mortgage rates are falling. And then again, throughout this period, increasing and steady, and mortgage rates are just plummeting. So that is actually the goal of what the Fed is doing with these rate hikes, is trying to get a healthier economy so the mortgage rates can drop. So it's not all bad news when the Fed increases rates, because it is with a goal in mind. And a healthier economy can equate to more people wanting to borrow money because they feel like they have a better situation to be able to borrow money, and the demand to borrow money drops interest rates. So that's what the Fed is trying to accomplish here. It's just taking more dramatic measures than they initially thought it would.
On my computer, so it's blaring in my ears.
All right, let's talk about
I think
inflation.
we've got somebody not on mute, so just double check everybody. If you're not on mute, can you go ahead and put it on mute? Cool, thanks, Tessa, go ahead.
Thanks. All right, so inflation, that's really the enemy here. So inflation reached 8.6% in May.
This is all good.
Up 7% in March.
Yeah.
Of course, that's going to hurt our mortgage rates. The other thing, the Fed is struggling to manage its balance sheet. So at the beginning of the pandemic, the Federal Reserve purchases assets. Well, all sorts of different types of things. Their balance sheet was at about $3 trillion at the beginning of the pandemic, or before the pandemic started. Once that started, from March to May 2020, they basically doubled their balance sheet. They went from $3 to $6 trillion. And that's significant because it was kind of a rescue for the economy. They purchased a lot of different types of assets, but a ton of mortgage-backed securities, which allowed rates to stay low. It allowed the housing market to remain afloat during that period. But now we're seeing the consequences of it. So, I mean, you can have your opinions on whether they should have done that or not. We really don't know what would have happened if they didn't. But the reality is now they've got this giant balance sheet that they don't want. And as they sell off mortgage-backed securities, or I don't know that they're selling off a ton at this point, but they're not purchasing anymore to reduce that balance sheet. It affects mortgage rates in a negative way. That will also increase mortgage rates. So they're struggling to manage that as well as playing with the interest rate, the Federal Reserve rate. All right, I said this in March and it wasn't true, but hopefully it's true now. We've likely seen the worst of inflation-related mortgage rate increases. But again, that is based on how things react, how inflation reacts to this most recent increase. And again, that's what the Fed's hoping, that they will curb inflation, but fear of a recession is increasing. If we do go into a recessionary period, that will also reduce mortgage interest rates, because in a recession, the demand to borrow money drops, which will also drop mortgage rates. Okay, global market impacts. What's going on in the world? So just a reminder, geopolitical events. I mean, you can read that. We talked about this a little more last time, but mortgage rates drop when there's global unrest. So main things to keep an eye on, again, Russia, Ukraine, and COVID. And okay, and this was interesting. I just saw this morning and added it to this slide real quick. The Swiss National Bank raised rates with their first rate hike in 15 years. So that was, and it was a complete surprise. So initially, yesterday, the mortgage rate reaction to our Federal Reserve increase was minor. It got better throughout the day. And then this morning it got a lot worse. And I think part of it was in reaction to this, the Swiss National Bank. So as much as we like to think our US economy is kind of independent, it very much, I mean, we're in a global economy. It very much relies on what happens throughout the world. So when something unexpected happens, even with the Swiss National Bank, it affects us here. And just that feeling that they felt they needed to raise their interest rate isn't necessarily a great sign for where the global economy's at. So that's just another thing to keep an eye on, is any surprises, and there could be many of them that we're not aware of at this point or are not expected but could happen. Okay, what does this all mean? So the Fed actions, initially that'll raise mortgage interest rates, but if it controls inflation, that will drop them. Any global unrest or a recession will drop rates. But just like last time, I don't know. Short term, it's really hard to tell now. I was much more confident at the beginning of the year how things would play out. But nobody has a crystal ball, and most of the experts have been wrong this year on what mortgage rates will do. But we did hear something at the housing summit yesterday that I'll share, I think, on this next slide. All right, so here's just a quick reminder of the history. You know, these were the good old days, 2-3%, actually not that long ago. In March, we were at 4.5. April, we hit 5. May, 5.5. And we hit a high of 6.25. I think it might be a little better now. And then, again, this is a general scenario. A lot of different factors impact a specific person's interest rate. But this is kind of where we're at. So there's the history, and I'm actually going to scratch the projection this time, but I will give you this. Short term, it's been sharp and painful, right? We've seen that, and we may see some more of that. But long term, and this is what we learned at the housing summit that I thought was really interesting, is long-term rates will drop, trend downward, and there's a global savings glut is what he called it. And this was James Wood from University of Utah. And that savings glut, when people save and don't borrow money, then that drops interest rates as well as an incentive for people to start borrowing money. And we have this savings glut because, and this is worldwide, this is kind of something that's been happening worldwide, and it's due to a few different factors. One is here in the US, we've really moved from a manufacturing economy to a service economy. So we don't have as many of the big manufacturing plants as we did in decades past. Think about the example they used is think about the car industry, how much capital and resources it takes to run a manufacturing plant for automobiles. Compare that to, Facebook or any digital service company, that the capital needs are just very different. The labor needs are very different. And so if they're still turning a good profit, but don't need to invest in much as capital, they have this glut of money. And then worldwide, you've got governments that are less democratic, I guess you could say, that have royal families and things like that. Saudi Arabia is a good example, where they have this huge national fund from their oil profits or whatever they export. And they have a ton of money just sitting around and they need to invest it somewhere. So all of that does point towards a downward turn in interest rates. So I thought that was interesting. So short term, it's been painful. It might be a little more painful long term. They should trend down for a variety of reasons. Okay, what could change this projection? Again, inflation. Rates could continue to climb if that doesn't get in check. Another global thing to touch on, there's been rumblings of a China currency crisis or Taiwan invasion. That's a very hot and cold issue. It just depends on when and who you talk to. And Ukraine could also, that one's an interesting one, how that's played out, but still there. Okay, I showed this last time, so I won't touch on it too much, but basically a quick update on the housing market. This graph shows housing units created versus households created. And for a long time, we were short. That's what this 44,000, as of 2020, we were 44,000 housing units short. And that's when you get kids living in parents' basements, et cetera, just a really high demand for housing. But 2021 was a great building year. And now estimates from the Kempsey Gardner Institute we're about 20,000 units behind. So we've almost cut this deficit in half. And that's why we're seeing a shift in the market, not as many multiple offer situations. Inventory is higher. Things are looking a lot better. So here we go. Inventory is increasing. I checked last night. There were nearly 7,000 listings in Utah. That's up from a low of between 2,000 and 3,000, I think. Average days on market, about doubled. And I'm sure you guys are seeing this as well with your current listings. Price reductions, especially in higher price ranges. Single family sales are expected to drop this year, but more affordable options, townhomes and condos, will likely be about the same. Then I think I forgot to put a slide in here, but now this is where we're getting into Bliss's part, I think. Oh no, that slide was just out of order. No, it wasn't. I was going to talk about this real quick. So you've probably heard things like this, waiting for the market to crash. They seem price cuts. Does that mean a crash is coming? So I just wanted to define real quick, what is a housing bubble? And that's a prolonged period, or when the bubble bursts, right? A prolonged period of decreasing home prices. Okay, during the recession of 2008, there were, I think it was 16 consecutive quarters where home prices declined. So that's 4 years. That's like 4 years solid of declining home prices. And that's the only true bubble in the Utah housing market, that we've seen. Most housing market slowdowns in Utah have been correlated with slow job market. So this is all I had time for. This curve is a very rough representation of what has happened in the Utah housing market from 1976 to current. So we have had periods of slowdown, these yellow periods. This red area, that was 2008. That's where it really tanked and it's gone down. And most of the time, slowdowns in Utah have been correlated with slow job markets, which we don't have right now. We still have a strong job market. So a slowdown is okay, because that means we're getting back to normal. So just because we're seeing that doesn't mean we're heading into a crash. So this is home price appreciation since 2007. So you can see again, the red is the recession, the crash of 2008. but we've been solid since then, between, I don't know, 5 and 8% for a lot of years until 2021 went bonkers, and we know that wasn't healthy. Okay, this one, so far, through the first 5 months, we're already at 25% appreciation, but by the end of the year, James Wood thinks we'll be down around 10%. So it started off crazy like 2021, but we are going to see a slowdown, and we'll probably end the year around 10%, which is much more healthy than where we have been. And that's, so even with this giant crash, right, from 2007 to 2022, we're still at about 86% accumulated appreciation on real estate, which is, even with a giant crash, that's still a fantastic investment over that time period. Okay, here we go. Now I'm going to turn it over to Bliss and let her talk about having conversations with your clients.
Awesome. Okay, so first of all, can we just all agree that Tyson is freaking amazing? Like, I can understand things when he says it. So thank you. I appreciate it. And I hope you guys got a lot out of that and feel confident talking to your borrowers. So I'm going to give you some tips about the emotional side of it. Tyson, go ahead and go to the next screen. Okay, so I've been having this conversation for probably about 3 months right now, since rates really started going up. And this is exactly how I say it to people. So you know what? You've probably heard, right, in the media, or you've checked around, rates are kind of ugly and they've been going up. But let me tell you why I think rates are not the most important part of the equation. Now, don't get me wrong, they are important, but they're not the most important thing. And here's the reason why. Interest rates are temporary, meaning I feel very strongly, and depending on the person, and obviously someone like an engineer will want more information. I'll go a little deeper into that conversation of why rates are temporary and why I think we're going to have a refinance. But truly, I feel within 12 to 24 months, there's going to be an opportunity for everyone that's bought this year in this rate environment to refinance. And so that's just one small piece of the equation. The other pieces are so much more important, right? Appreciation. Look at the statistics that Tyson just showed. Even if we have a small dip, you are going to be seeing an average of 5% a year appreciation. Was it someone yesterday, or they said you can't it was when we were with Carla the other day, you can't outrun inflation. I thought that was brilliant, right? Don't stick your money in a savings account. That's not going to help you, right? You can't outrun inflation. So building wealth through home ownership is one of the safest and true and tried method to do that, right? Start building wealth. You look at, there have been lots and lots of studies, there's lots of statistics out there that show the huge gap in wealth between a homeowner versus a non-homeowner. For example, a young couple bought a house a couple of years ago, actually just a condo, and he got laid off during COVID and they got into a ton of debt. I mean, we're talking a lot of debt through that really difficult time. But they're able to get themselves out of that situation with a refinance to pay off that debt, and their house payment is still less than if they were to go and rent something right now. It's just shocking, right? And they still have a lot of equity in their home, right? Where someone else in that situation, their rents are just going to keep going up and up and up, right? Something I don't think we realize about mortgages is it's actually a forced savings plan, because a portion of your payment every month goes towards principal. A portion of your payment is tax deductible, your interest, your mortgage insurance, your property taxes. So more of your earnings can stay in your pocket for you to save and build wealth, right? When you rent, you are paying 100% interest. I know you guys have probably seen some of those memes and stuff going around, but it's true. And when you rent, you have no control over your housing expense, right? You can downsize if rent keeps going up, but I fear for the state of Utah that we're going to have a large number of what I call working homeless, right? That's people that don't have a place to live. They have a job. They're not affected necessarily by mental illness or drugs, but they're couch surfing or they're trying to find a place to park their RV because that's what they can afford, right? And so you can't outrun inflation. So build wealth through home ownership. And I think that's critical. Next slide, Tyson. All right, so vital questions to ask. And this is as you're talking to your clients, right? And you have lots of questions you're asking them. I do want to preface it by the first time I talk to a client, my first question always is, tell me a little bit about your situation. And then I sit back and I want them to just talk because I get lots of information that way. And sometimes people are like, well, I don't know what you mean. They're not even sure, right? I'm just like, tell me why you're thinking about buying a house, right? And that you can find out job changes, kids coming. I want you find out more about them. So I didn't put it on the screen, but I think that should be your first question. So they really feel like you care to listen to them. Then your first question after that is, how long do you plan on living in the home? Right? We're talking about home values appreciation and why the interest rate isn't very important. Well, that really comes into play if you're going to be in a home 3 or more years, right? If you're only planning on being in it 1 to 2 years, it might not be the best decision for you, right? 2 years ago, it would have been, absolutely. But so finding out their needs and their plans is a great thing to do. Then I think it's important to ask, how much are you paying in rent right now? And do you think that will go up? And if they're like, well, I don't know, it hasn't yet, you can maybe cite some statistics about Utah's rental market and what's happening in our market and how rents really are going up drastically. And then, do you think your income will be increasing? This is really important because if we can kind of plant that seed, yes, interest rates are high. Your payment's gonna suck compared to where it was 6 months ago. That's just how it is. I'm just being honest with you. But in my opinion, most of the people I'm talking to either recently got a raise or they are anticipating a raise. I have this young couple started talking to me last fall, and he was making 62, got raised up to 77, 78, and just got raised up to 92, right? Makes all the difference. Income is important. And I think you'll find that a lot of people are getting raises right now or anticipating it. And if you can help them kind of see that as part of the equation, feel comfortable with it, my good friend, her daughter and son-in-law, they're buying a house, they're qualifying just literally by the skin of their teeth on his income, but she is almost done with a paralegal course. And so their income is going to be going up. And the bottom line is I can usually qualify people for more than they're really comfortable with debt to income ratio. So I like to find out, do you have other income sources? Do you have the potential for more income? And I think you being concerned about that for them, and they know that you're really on their team, looking at this not just today, but long term, I think is going to help people really feel connected to you and really trust in your advice. So cool. Next slide. All right, so now why it's a great time to buy a house. There's probably more reasons, right? No more appraisal gap money, more than likely, maybe in the 350, 400 range, right? But a lot of people were having to come up with an extra 10,000 for an appraisal gap. So if you're really worried about this payment being higher because of the interest rate, there's a lot of people that were looking for houses, couldn't get accepted offers. You're going to be able to keep a little bit more money in your bank account to give you a safety net for that higher payment. If your tire blows or if you have a medical bill, right? We don't ever want people to feel house poor. And this might be a good thing to point out in this market. And then possible seller concessions, right? A seller even willing to pay $2,000 in closing costs. I think we're going to start seeing more of that. My buyer can keep $2,000 in the bank as a safety net, as a comfort zone, right? And then more inventory, more choices, and of course, less competition. So those are kind of all of the things that I felt were tied to the emotional side. So for example, I have a guy right now moved here from Washington State, works for Amazon. He makes a lot of money. He does, base salary plus all kinds of other incentives. And he's looking at around 500,000. And so I was able, and he's having a hard time, obviously, right? Because there are $500,000 houses, but depends on where your needs are. And so I was able to point out to him, you know what, based on your income, your net payment after tax advantages is lower. And so I think just understanding all of these things and the needs and wants of your clients helps you to have conversations that in turn help them, that if it's right, if they qualify, they just get that little bit of a nudge of, okay, I'm okay doing it. Because if they wait 2 years till rates drop down, prices are going to be up at least 10%, right? And then you're going to be back into a competitive market. And so those are my thoughts. I would love to open it up if anybody has any thoughts or questions on anything Tyson or I have discussed. Anybody have any other conversation things they want to share that they've used with their clients that have seemed to go well? Anybody want to share? I know you guys are out there talking to people. You have great ideas too.
Liz, I have one. Is that okay if I share?
Absolutely.
I just let people know right now, like you have on the screen, the benefits of them buying right now. As Bliss mentioned, that there is potential for a refinance in the future. People tend to think like, oh, I don't want to pay closing costs twice. Well, use now as an opportunity to really save on your closing costs so that you do have the money in the future to, if you needed to pay closing costs in the future, if you wanted to buy down your rate, because it just doesn't make sense for people to do that right now.
Yeah.
So I love having them looking at it as a shorter term. When you're looking at this rate at 6%, don't think that you're stuck with this for 30 years. Because there are a lot of people that are like, oh my gosh, that's so scary for 30 years.
True. And it has scared a lot of people. Absolutely. Thank you, Sam. I appreciate that. Anybody else have any other thoughts on any of this or questions?
Yeah, Bliss, this is Richard.
Yeah, Richard.
Just to piggyback what Sam said, it's just helping, clients understand the long term, that rates are not going to stay where they are forever. They will go back down. We've seen that over time. So it's okay to buy, and then kind of like Sam mentioned, holding off on buying down the rate and whatnot. But just more importantly, I guess, helping them with that mindset that, you're still going to pay. And so it's okay to buy. And then most people refinance within 2 to 7 years anyway.
Yeah, true. Cool. Awesome. Thanks, Richard. Anybody else have questions? Okay, well, I appreciate everybody being here. We had a great turnout. I know this is such a hot topic. Happy to discuss it with you guys in detail individually if you want to call Tyson or I. And we would love to help your clients. Even if they say, you know what, I just really don't want to do anything for 6, 12 months, we're okay with that. Let us have a conversation with them so that in 6 or 12 months, they're in the best place possible to buy a house then. And so that's what we're here for, really, to be a resource, whether it's a client that's ready today or a client that might be in the future. And then we work really hard to keep them tied to you and to us so that they know they've got a team surrounding them. So thanks everybody for coming today, and have a great day.